Welcome to the video. First, we will set the stage for why a low-income year can be the perfect moment to execute a strategic Roth conversion. Then, we will walk through the math, steps, warnings, and a practical plan to carry it out. Finally, we will test your knowledge and wrap up with key takeaways. Before we dive in, a brief but important disclaimer. This content is for educational purposes only and does not constitute tax, legal, or investment advice. Tax laws, bracket thresholds, deductions, and credits change over time, and your circumstances are unique. Therefore, consult a qualified tax professional or financial planner before taking action. Examples and numbers used here are illustrative and simplified for clarity. Next, here is today's roadmap. We will begin with the core idea of why a low-income year is your financial superpower. After that, we will simplify the bracket math. Then, we will move through the practical workflow for executing a conversion, discuss consolidation and cost-cutting, and highlight critical warnings. We will also map a timeline, test your knowledge with a short quiz, and close with key takeaways. To begin, here is the big idea. A low-income year typically places you in a lower marginal tax bracket, which creates valuable headroom to convert pre-tax retirement funds to Roth at a lower tax cost. Since Roth accounts grow tax-free and qualified withdrawals are tax-free, paying tax at a temporarily lower rate can be advantageous over the long term. This is also a smart moment to clean up old, high-fee accounts and consolidate. However, proceed carefully. Be aware of cliffs such as ACA healthcare subsidies, Medicare IRA surcharges in later years if applicable, and certain tax credits. These factors can be affected by increases in income due to a conversion, so plan accordingly. Now, let us make the math simple. The objective is to convert as much as possible while staying inside the target, lower tax bracket. The straightforward formula is bracket room equals the bracket top minus your taxable income. Taxable income is your income after subtracting deductions. If you are planning using pre-deduction figures, remember to apply the standard deduction to arrive at taxable income. For an illustrative example, assume the top of your chosen bracket is $100,000, and your taxable income is $62,000. In that case, you have roughly $38,000 of room for a Roth conversion before spilling into the next bracket. Crossing into higher brackets such as 24 or 32% can quickly reduce the benefits, so convert strategically. These numbers are for illustration only. Moving on, here is the practical workflow. First, inventory all retirement accounts, including old and current 401k plans and any IRAs. If your old 401k has high administrative or investment fees, roll it into a low-cost traditional IRA to gain better control and reduce costs. Next, determine the target conversion amount using your bracket room calculation. Then, convert that amount from the traditional IRA to a Roth IRA. Reserve sufficient cash in a taxable account to pay the tax due on the conversion. Finally, maintain records of all confirmations and the tax forms that will be issued, such as the 1099-R for distributions and the 5498 for IRA contributions or conversions. Next, let us talk about consolidation and costs. If you are stuck in an old 401k with high administrative or investment fees, rolling out is often a priority to stop unnecessary drag. Using a low-cost traditional IRA provides control and broad investment options. You can then convert the targeted amount to Roth while leaving remaining funds either in the traditional IRA or rolling them into your current employer's superior plan. Consolidating accounts simplifies your financial life by reducing paperwork, clarifying your asset allocation, and making rebalancing more straightforward. Now for the critical warning. Do not pay your conversion taxes by withholding from the IRA you are converting, especially if you are under 59.5. Doing so creates an immediate taxable distribution and, if under the age threshold, likely triggers a 10% early withdrawal penalty. Instead, pay the tax from outside savings so the entire converted amount remains in the Roth to compound tax-free. To make this feasible, plan your cash needs ahead of time so that when taxes are due, you are prepared and do not have to disrupt your investment strategy. Continuing, visualize the journey on a timeline. Early in the year, gather documents and estimate income through the middle of the year. Monitor changes and model your bracket room as your income picture evolves. In the fall, finalize the conversion amount and ensure you have cash for taxes. By December, execute the conversion before the end-of-year deadline. In the following tax season, collect the 1099-R. reconcile the conversion on your return, and pay any tax due by the filing deadline. Then, adjust your withholding or estimated payments for the next year based on what you learned. Next, compare the strategy across different income environments. In a low-income year, your marginal rate is lower, which makes the conversion less costly and provides more room before reaching the next bracket. It is also a convenient time to consolidate older accounts, potentially locking in many years of tax-free Roth growth at a discount. In contrast, in a normal or higher income year, conversions can be more expensive, room is tighter, and it may be prudent to delay or limit conversion amounts. The goal is to align the action with the most tax-efficient timing. To make the arithmetic concrete, consider these illustrative scenarios. In example A, with a bracket top of $100,000 and taxable income of $62,000, the room is $38,000. In example B, with a bracket top of $201,000 and taxable income of $110,000, the room is $91,000. In example C, with a bracket top of $100,000 and taxable income of $97,000, the room is only $3,000. These are simplified examples for demonstration and do not reflect actual IRS thresholds for any specific filing status or year. Quiz time. Question: where should you pay the tax bill from when doing a Roth conversion in a low-income year to avoid penalties and preserve tax-free growth? Option A, from outside savings or a taxable account. Option B, by withholding directly from the IRA you are converting. Option C, by taking a distribution from the Roth right after converting. Option D, by borrowing from your 401k loan feature. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is from outside savings or a taxable account. Paying taxes from outside cash preserves the full converted amount inside the Roth and avoids early withdrawal penalties if you are under 59.5. Second question: what is the simplest formula to estimate how much you can convert without entering the next tax bracket? Option A, room equals bracket top minus taxable income. Option B, room equals gross income minus standard deduction. Option C, room equals adjusted gross income minus withholding. Option D, room equals Roth balance minus traditional IRA balance. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is room equals bracket top minus taxable income. This represents the headroom available for a Roth conversion while staying within the target bracket. As we near the finish, here are pro tips and common pitfalls. First, model your bracket room conservatively. Second, be aware of cliffs such as ACA subsidies, education, and child credits, and eventually Medicare IRMAA. Third, understand the IRA pro rata rule. The IRS aggregates your pre-tax and after-tax IRA dollars when determining the taxable portion of a conversion, and you must track any after-tax basis on Form 8606. Fourth, remember that Roth conversions must be completed by December 31st to count for that tax year. Finally, consider adjusting withholding or making estimated tax payments to avoid underpayment penalties. To recap, a low-income year is a prime window for discounted Roth conversions. Fill your current bracket without crossing into the next one. Consolidate accounts and reduce fees to simplify and save. Always pay taxes from outside cash, not by withholding from the IRA you are converting. Plan using a timeline, document the necessary forms, and adjust your approach in the following year. In summary, estimate your taxable income and bracket room using the simple formula. If appropriate, roll a high-fee 401k to a low-cost traditional IRA, then convert only the target amount this year. Pay the conversion taxes from cash to avoid penalties and preserve tax-free growth. Execute the conversion by December 31st and reconcile with the 1099-R and 5,498 during tax season. Finally, iterate annually to continue optimizing across multiple years. As we close, thank you for watching. If this was helpful, please like the video, share it with someone who could benefit, and subscribe for more practical strategies. I would love to hear your plan in the comments. What will you convert this year and why?